June 12, 2026. The most anticipated IPO in the history of financial markets goes live. SpaceX, ticker SPCX. Valuation $1.77 trillion. That makes it, on day one, larger than Tesla, larger than Amazon. The biggest debut any company has ever attempted on a public exchange. Wall Street is euphoric. Retail investors are refreshing Robinhood at midnight. And Elon Musk just handed everyday people a 30% slice of the float. But here's what they're not telling you. In 2025, SpaceX made $18.7 billion in revenue and lost $4.9 billion. Then in the first quarter of 2026 alone, another $4.28 billion gone. So why is the most celebrated company in aerospace trading at a valuation that makes profitable titans look cheap? And more importantly, is this the opportunity of a generation or the most beautifully engineered trap in stock market history? Let's start with the numbers because they are genuinely insane and not in the way SpaceX fans want to admit. $18.7 billion in revenue. That's not a startup. That's a real industrial-scale business generating serious cash. Starlink subscriber fees, Falcon 9 launch contracts, government deals with NASA and the Department of Defense. The money coming in is extraordinary. But then you look at what's going out. A $4.9 billion net loss in 2025. And if you thought that was a one-year anomaly, Q1 2026 erased that hope immediately. $4.28 billion more in losses in just 90 days. Now, before you close this video, this is where most financial analysts get lazy. They call it reckless. They compare it to the dot-com bubble. But that framing misses something critical. Amazon lost money for years, deliberately, reinvesting every dollar back into infrastructure so aggressively that Wall Street called Jeff Bezos insane. We know how that story ended. SpaceX's losses aren't operational failures. They are capital expenditures disguised as red ink. Starship development, Starlink version 3 satellite manufacturing, the Mechazilla catch system, a second launch site in Texas. These aren't losses, they are bets. Enormous, calculated bets on infrastructure that, if it works, becomes a moat that no competitor can cross for decades. But here's the uncomfortable truth. That argument only holds if those bets pay off. And to understand why investors believe they will, you need to understand the move that almost nobody is talking about. On the surface, SpaceX is a rocket company. But the filing documents for this IPO reveal something that changes the entire investment thesis. SpaceX and xAI, Elon Musk's artificial intelligence company, have completed a strategic merger. And what they've built together is something the tech world has never seen before. Starlink version 3 isn't just an internet constellation. Each satellite carries significantly more processing power than its predecessors, and they're networked together using laser inter-satellite links. What SpaceX has effectively built is a distributed supercomputer in low Earth orbit, one that covers every inch of the planet. Now combine that with xAI's Grok infrastructure and Musk's access to Colossus, the Memphis-based supercomputer cluster, and you have a vertically integrated AI compute stack unlike anything else on Earth, or above it. Here's where it gets genuinely remarkable. According to data embedded in the IPO prospectus, SpaceX has signed compute rental contracts with major AI companies, including Anthropic and Google, who are paying to access SpaceX's orbital and ground-based compute infrastructure. Think of it like AWS, but the data centers are satellites, and the bandwidth is global, real-time, and militarily hardened. Why would Anthropic and Google pay SpaceX for compute instead of building their own? Because Starlink from Team 3 offers something ground-based infrastructure physically cannot: latency-resistant, interference-resistant, globally distributed compute with no single point of failure. For AI inference at planetary scale, that is a genuinely differentiated product. And this is the bet the bulls are making. Not that SpaceX is a rocket company, but that SpaceX is becoming the infrastructure layer for the next decade of artificial intelligence, the pipes and servers that power the models reshaping civilization. If that thesis is right, the losses don't just make sense. They make the company cheap at $1.77 trillion. But there's one more piece of this story, and it directly affects you. Elon Musk made a point of announcing this publicly. Up to 30% of the IPO float, shares available on day one, will be allocated through retail-friendly platforms like Robinhood and SoFi. The message was clear. This isn't just for Goldman Sachs and hedge funds. Regular people can get in at the IPO price. It's a genuinely compelling offer. Historically, IPO allocations go to institutional investors. Retail traders get scraps, or they buy on the secondary market after the stock has already popped 20, 30, 50%. Getting in at the ground floor at $135 per share sounds like an obvious win. But history has a very specific lesson here, and it is not comfortable. Uber, Lyft, Rivian, WeWork. Each of these were generationally hyped IPOs. Each had armies of retail investors lined up at midnight, and each of them, within 12 months of their debut, had lost anywhere from 40 to 70% of their IPO value. The pattern is consistent. Retail excitement drives a first-week spike. Institutional investors, who got in even earlier at pre-IPO valuations, use that retail momentum to sell. The people who thought they were getting in at the ground floor were actually holding the exit door open for the people above them. Now, is SpaceX different? Possibly. The underlying business case is stronger than Uber's was in 2019. The AI compute angle is real. The Starlink cash flow is real. The government contracts are real. But you are still being asked to pay $1.77 trillion for a company burning through $4 billion of cash every single quarter? The margin for error is zero. If the AI compute thesis plays out and the losses flip to profitability by 2027 or 2028, this stock could look like Amazon at year 2. If it doesn't, if a single major Starlink 5.3 deployment fails, if the XAI integration runs into regulatory walls, if a competitor like Amazon Kuiper closes the performance gap, this could be Rivian in a spacesuit. The retail allocation isn't a trap or a blessing. It is exactly what investing always is, a decision made under uncertainty, where the quality of your reasoning matters more than the size of your enthusiasm. Here's where we land. SpaceX going public is a historic moment, full stop. The company changed what humanity believes is physically possible. The Starlink constellation is a genuine infrastructure revolution. The XAI merger and the compute rental model with companies like Google and Anthropic could be the business model of the next decade. But $1.77 trillion is an extraordinary price to pay for potential. The balance sheet is bleeding, the losses are real, and history has a long memory for the times when hype outran fundamentals. I want to know what you think. Is SpaceX at $1.77 trillion a generational buy? Or the peak of the hype cycle? Drop your answer in the comments right now. The debate there is going to be better than anything on CNBC. And if you want to be in the room when we break down the first week of SPCX trading, the numbers, the moves, whether institutions sold into the retail excitement, hit subscribe. That video drops the moment the data does. I'll see you there.